key concept in accounting is adjusting entries. An adjusting entry is an entry made in the general journal to record revenues that have been earned but not recorded and expenses that have been incurred but not recorded. There are 4 kinds of adjusting entries: deferred revenue, accrued revenue, deferred expense, and accrued expense. Deferred revenue is when the company receives cash before the revenue is actually earned. Deferred revenue is also referred to as unearned revenue, and it is recorded as a liability. For example, concert tickets. The concert company receives the money when you pay for your ticket. However, the revenue is only earned when you attend the concert. Let's take a look at how you record a deferred revenue. Before the company earns the revenue, they should increase both cash and unearned revenue by the amount received. As the revenue is earned, the company decreases the liability account and increases the related revenue account. Accrued revenue is when the company provides a service before receiving the cash. It is also known as accounts receivable and is recorded as an asset. For example, when you go to work, you will not receive the cash for your services until the next pay period. Let's take a look at how to record an accrued revenue. As the company earns the revenue, they should increase both accounts receivable and service revenue by the amount earned. When the company collects the receivable account decreases and the cash account increases. Deferred expense is when the company pays cash before the expense is incurred. It is also referred to as a prepaid expense and is recorded as an asset. For example, rent. You pay rent for a certain period in advance and are then able to occupy the house or apartment. Let's take a look at how to record a deferred expense. When the company pays cash, cash decreases and the prepaid asset increases. As the asset is consumed, the prepaid expense is adjusted down and the expense account is adjusted up. Accrued expense is when the company incurs an expense before they pay it. For example, electricity expense. Companies use electricity and pay for it when they are billed at the end of the month. As the expense is incurred, accounts payable increases by the amount owed and the expense account increases by the amount used. When the company pays off the account, accounts payable and cash decrease.